Question 9a had an average of 47%, right around the overall exam average, and we were asked to prepare the operating section of the budgeted cash flow statement for the month ending 31st of October 2015. 7-mark question, so quite a heavy weighting for this, so it's really important that you know what operating activities are. So operating activities will be any cash flow from the provision of goods and services in the day-to-day operations of the business. So our inflows will come from selling goods and services, and our outflows will be from paying employees and suppliers so that we can provide those goods and services. So if we do a little table, we can contrast the inflows with the outflows that we'll expect from operating. So the main inflow will be selling goods for cash. Contrast that with the outflow, which would be buying the stock that we've sold, but only the cash purchases of that stock. Cash inflow, we expect to see some collections from debtors for most businesses, and the opposite of that would be payments made to creditors. We could have a commission received, which is not a very common transaction, but we do want to keep it on our list of possible things to look for. So that would be another revenue. Cash outflows, what we'll do is just bundle all the expenses together and as a general category and say, let's look for any expense that's been paid during the period. On the cash inflow side, we could also have another revenue in the form of interest. Obviously, interest paid would be an expense, so we want to look for that too. Then we want to have a look for any GST that we collect during the period from selling goods and services. And the opposite of that would be we want to budget for any GST that we pay during the period. The last one that we can look for is maybe there's a GST refund or a GST settlement. So in either case, maybe we settle our GST balance during the period, and therefore we want to look for an inflow or an outflow from that. The facts of the case are really important here. So what we want to remember is, first of all, we've got a monthly reporting period. Secondly, sales of stock are on credit, so we don't want to look for any cash sales. And lastly, purchases of stock are for cash, so we won't have any creditors, and therefore we won't have any payments to creditors. Once we've got that, we've got all the account balances from the balance sheet. Now on their own, they are not actually cash flows, they're just balances telling us what we have at the end of October, at the start of October, and what we expect to have at the end of October. So what we probably want to divert our eyes to is the additional info. We're going to use that as our basis as a checklist. So whenever we get a question like this, we want to do it strategically and go through each dot point one at a time. So the first thing we've been told is the business expects credit sales of $50,000 plus GST in October. So if all sales are on credit, that means that debtors control figure will change. However, what we want to remember is there will be no cash sales. If sales are only made on credit, the only thing we want to look for is receipts from debtors. So to do that, that's going to be quite tricky. So this question didn't ask you to do a debtors control ledger, but doesn't mean you can't do one on a scrap bit of paper or in the margin. And that's going to be the easiest way to answer this question. We just do a little T account on a bit of paper, and let's take the info we've been given to recreate this, and then we'll actually be able to figure out how much cash we expect to receive from debtors. So taking one point at a time. On the 1st of October, we're told that the balance of debtors will be $48,000, so that would be a debit at the start of October. The end of October, we're expecting a balance of $51,000. So what we do is we balance that on the credit side and carry it down on the debit side. And then the only other bit of info we've been given is the business expects credit sales of $50,000 plus GST. And that would actually be a debit in that account. Sales slash Gst Clearing would increase it by $55,000, and that's all the info we've been given. So what we want to remember is all the other things that could make debtors go down. So there could be bad debts, there could be someone paying us back. Now in this case, there's no information about bad debts. So it could also be a discount expense, and again, that information wasn't given, so we can ignore that. So what we can assume is that the one figure we are missing is the how much cash we have received from our debtors. So to do that, we're just going to solve for X. We're going to total that debtors control ledger up on the debit side and get 103,000. And once we've got that number on the credit side, we can look at that and solve for X by taking 103,000, minusing away 51,000 to get 52,000. So we're going to plonk that figure up here in our cash flow statement. So the total receipts from debtors must be 52,000. Is there GST collected? That's another inflow we want to look at for operating. And this is where we need to remember the facts of the case. So don't overlook the introductory sentences. And we're told all sales of stock are on credit. So that must mean there's no GST collected If all sales are made on credit, all the GST we get is actually buried in that receipts from debtors figure, so we can move on to the next item. So what we want to do is tick off the info we've used in blue and then move to the next bit of info and just keep ticking things off strategically. So the next bit of info we haven't used is wages paid will be $23,200. We can see in the balance sheet balances there, we've got some accrued wages, and that's going to directly relate to that wages paid figure. So let's figure that out. We're told that wages paid during October will be $23,200. The issue here is we want to probably best to create some little T accounts as well. And what we're told is at the start of October, accrued wages, which will be a liability, have a balance of $1,700. We're also told the balance at the end. Now on its own, that's not going to affect our cash flows, so we're going to ignore that for now. So what we want to remember is this $23,200 for all wages paid is actually going to be for two things. The first part will actually be to take care of the $1,700 of accrued wages. So what we'll end up with is a debit to accrued wages to reset it back to zero, and we'd have a credit to cash of $1,700. So the numbers in this cash ledger are the numbers we want because we're doing a cash flow statement. So that must mean the rest of that payment was actually for wages this period, so that would be an expense. So the other $21,500 will be wages, plus the $1,700 for accrued wages last period, together would equal $23,200. So what we can do is go up to our cash flow statement now and enter wages paid in brackets to represent an outflow of $21,500 and accrued wages of $1,700. The next dot point we haven't used is rent is paid 3 months in advance at $2,000. We've also been given some prepaid rent information there. That's an asset. So let's figure out how much cash is actually being paid during this period for rent. So what we're told is we need to figure out a prepaid rent figure, but we don't know what it is. So let's just go and plot the information we have. We are told at the start of October we will have a prepaid rent balance of $2,000. And at the end of October, we actually don't know what that balance will be. So what we're told is rent will be paid 3 months in advance in October. So that payment there actually isn't for October's rent. It will be for November, December, and January's rent. And what we're told is it's $2,000 per month. So in November, that'll be $2,000. However, the rent charge will increase by 10% from the 1st of December onwards. So we don't know how much will be paid for December and January. So to do that, we're just going to take that $2,000 figure from November, add 10% to it, and we'll get $2,200. So what that must mean is the payment in December will be $2,200, the payment in January will be $2,200. So how much are we actually going to prepay in October? So in October, we're going to go and prepay this one, and this one, and together if we add those numbers we get $6,400. So that will be the figure that we put up in our cash flow statement for prepaid rent. The next bit of info we haven't used is interest on the loan is $5,400 per annum, paid half yearly in March and October. So we're going to need to put in interest paid and a figure that we have to calculate. So what we're told is it's $5,400 per annum. Always best to divide this by 12 to get it into a monthly figure. So the interest every month is $450, and then the information says we're going to pay twice per year, once in March and once in October. What's unusual about this is not 6 months apart, it's 7 months apart, which can be a little bit confusing, but essentially this is what's happening. In March, we're going to pay for the first 6 months of the year. So that would be 6 months at $450 is $2,700. So it's one payment in March for all of those 6 months. In October, we're making one payment of $2,700 to cover those 6 months there. Now our budget is just for the month of October, so we're going to enter $2,700 as our cash flow for the payment of 6 months of interest from July to December. That is going to be made in October. So the figure of $2,700 will go on our cash flow statement. Takes us now to cost of sales. That is not a cash flow, so we can ignore that item. We're then told cash purchases of stock will be $18,000 plus GST, and remember that we don't buy any stock on credit, so there's not going to be any payments to creditors, so we can quite easily put that in under stock purchased, $18,000. We then have depreciation of machinery is 12%, so depreciation is an expense, but it's not a cash flow, so we could ignore that item too. And now we're done with all the additional info. So what we want to do is go and look at the things still left over that we haven't used. So under the account balances section, we've still got some items. So let's look at the loan amount. So clearly we're going to pay back $5,000 of the loan during October. This is not going to go into our report though, because we're only doing operating activities, and a loan repayment would be a financing, so we're going to ignore that. Looking at the machinery, it doesn't look like we're going to buy or sell any machinery, and even if we were, that's not an operating activity, it's an investing, so we can ignore that. And that just leaves us with Gst Clearing. So what we're told is the balance is $600 credit, so that's a liability at the start of the month. And then we're not told what the balance at the end is. Now we don't actually need that balance. What we want to look at is, do we pay or collect any GST? So to do that, what we want to remember is GST, what are the things that make it go up and down? So we can make it go up by collecting GST on sales, and it can go down by being paid on purchases. The opposite of that would be if we make credit sales, we charge GST to debtors, and if we buy stock on credit, that would decrease our liability. And the other transaction we want to look for is, do we receive a GST settlement or do we make a GST payment? So let's use the info that we're told and sort of try and rule out the ones that we don't need to look for. The first thing we're told is sales of stock are on credit and purchases of stock are for cash. So that rules out any GST collected on sales, because we don't have any cash sales. And it also rules out any GST charged by creditors, so we could ignore those. Now, the GST charge to debtors, that is something that happens for this business, but it's not actually a cash flow, so I can ignore that. Looking at the GST settlements, did we receive or pay a GST settlement? Well, there's no proof or evidence, there's nothing that says that, so we can ignore that. And that just leaves us with GST paid on purchases. So that's the only cash flow related to GST that we're going to need to look for. So the best way to do that is wait until you've done every other item and figure out which items have GST. So looking at the operating activities section, we can see we've got receipts from debtors. Now that's an inflow, so we're not worried about that one. All we're going to do is go through each item one by one and figure out which ones have GST. So we've got wages paid, well that does not have GST, and therefore neither does accrued wages. Looking at prepaid rent, rent is an item that has GST, so we better put that into our calculation for GST payments. Interest is an expense, but it actually doesn't have GST, so we could ignore that one. And that leaves stock purchased of $18,000, so that will have GST. So basically what we're left with is total cash flows of $24,400 for items that have GST. We'll times that by 10%, and that must mean we're expecting to pay GST of $2,440. We've now completed our cash flow statement, so let's look at what the marks were for. We had 1 mark for receipts from debtors, we had 1 mark for wages paid, and 1 mark for accrued wages. What you can also do here is for 2 marks, you can just write wages paid $23,200, that would be fine and that's acceptable. Prepaid rent, $6,400 was 1 mark, 1 mark for interest paid, 1 mark for stock purchased, and 1 mark for GST paid. Looking at the mark breakdown here, we can see pretty well done, 16% of kids got 4. But at the top end, it was very difficult for kids to get full 7 out of 7. There's some tricky items in there related to the interest and also the prepaid rent item, and only 6% of students were able to get 7 out of 7. The average was 3.3, so a little bit under half, and the examiner's comments were the wages and accrued wages can be reported separately or together as we saw, as long as the total equals $23,200. Students should be aware that correct titles should be used. So a cash flow statement is a descriptive report. So we're writing stock purchases or cash purchases of stock. We're not writing stock control. We write receipts from debtors, not debtors control, etc. And then we want to avoid including alien items, so things that have no place in a cash flow statement like credit sales, depreciation, loan repayments and so on. And alien items are really important because they will cost you a mark every time you present an alien item in your reports.